Okay, good morning, everyone, and you're very welcome to our second results webinar of the week. We've got 12 companies presenting across 4 sessions this week. This is our third one, not our second one, our third one. I'm even losing count myself. But you're very welcome to this morning's event. My name is Mark Tobin. I'm the founder of Coffee Microcaps. For anybody who is joining us for the first time, and any of our regular attendees, you're very welcome back. I'm just going to quickly run through these slides and then we'll get straight into it with our first presenter. First off, I'd like to mention DMX Asset Management, our sponsors here for the whole of 2026. If you are looking for an active manager in the micro cap and indeed small cap space, please do check out their website for the relevant PDS and TMD, or indeed reach out to Stephen or Michael at DMX, and I'm sure they'll be able to answer any questions you might have about the funds. And welcome to ASIC, as always. Great to have you with us if you're with us. For anybody who is joining us maybe for the first time, the companies we tend to have presenting on here, capped under 300 million, our definition of microcap in revenue, approaching cash flow break even, or are already profitable, as we will see from some of our companies presenting this morning. So we tend not to have companies from the resources and biotech sector, what I like to call industrial microcaps, but that covers everything from technology to financial services, professional services, hardcore industrial products businesses, retail, basically anything that kind of drops out of biotech and resources. Structure this morning's webinar, we've got jam-packed webinar this morning. We've got 5 companies presenting, each one with 30 minutes, which we break down into 20 minutes for presentation and 10 minutes of Q&A, give or take. If you do have any questions for any of our presenters, please type them in the chat function in the Q&A function rather than the chat function. Just makes it easier for me to moderate them. And please note the webinar is being recorded and will be up on the Coffee Microcaps YouTube channel tomorrow morning. So if you have missed any of our sessions earlier in the week, or maybe can't stay for the full session today, you can watch the recording tomorrow morning on the YouTube channel. And speaking of social media, we're pretty much on most of them. Twitter, YouTube, LinkedIn are 3 main ones. And I do write a free monthly newsletter, which will be going out the middle of next week, which will do a recap of all of these sessions as well. So if you've missed any or aren't sure which company presented, you can catch a quick review in the newsletter next week. Our presenters this morning, we're going to kick off with a returning presenter, BNK Banking Corporation. We've got Allan, Savins CEO, standing in the wings here. Then we're going to go to Melbourne. We've got Stephen Lydeamore coming back to give us an update on Immuron. Then we're going to head out west. We've got Mark Waller coming back to give us an update on One Click Group. Then we'll be welcoming back Jeremy Steele from Control Bionics, talking through their announcement from yesterday and their result. And then finally, we will be welcoming a new presenter, Patrick Bodegraven from Orcoda, who is the new CEO at Orcoda. We have had Jeff Jameson from Orcoda on before, but it'll be good to hear from Patrick, the new man in the hot seat. And speaking of hot seats, I am going to stop sharing here and hand you over to Allan Savins, CEO of BNK Banking Corporation. Allan, good morning.
Morning, Mark.
I can see the cover slide of your presentation now, Allan. You can take it away whenever you're ready.
Thanks, Mark. And good morning, everybody. And thank you for the opportunity to present at Coffee Microcaps. My name is Allan Savins, and I'm the CEO of BNK Banking Corporation. For some of you today, this may be your first introduction to BNK. So today I want to give you a clear understanding of who we are, the strategic turnaround that we've executed, the momentum that we're building, and why we believe BNK represents a compelling microcap investment opportunity. BNK is an APRA-regulated Australian bank with more than 40 years heritage, operating with an unrestricted banking licence with a presence across major states and offices in Sydney, Perth and the Gold Coast. We operate 2 brands, Goldfields Money, being our deposit origination platform, and Better Choice, our lending brand. We distribute nationally through mortgage brokers and aggregator partnerships. In addition to our lending distribution, we also source the majority of our deposit flows through third-party intermediaries and increasingly through digital channels. BNK is small, focused, and disciplined, but with the regulatory framework, funding platform, and product breadth of a much larger bank. Today, BNK is a microcap bank executing a deliberate multi-year turnaround with a credible pathway to sustainable profitability and long-term shareholder value creation. Our products serve a broad customer base, but they are well suited to SMEs and self-employed individuals. This is a large and growing segment. More than 4 million enterprising Australians are often underserved by the major banks. These customers need flexible, property-secured lending solutions, and that is where BNK is positioning itself as the bank for enterprising Australians, with immediate focus on ambitious individuals and growing businesses. Our lending approach is pragmatic and designed to support borrowers with strong cash flow fundamentals, even when traditional documentation sometimes isn't available. BNK offers one of the most diverse property-secured product suites among microcap ADIs, spanning prime and commercial loans, as well as specialist residential solutions through our Goldman Sachs off-balance sheet funding line. Our specialist residential proposition primarily supports creditworthy SME borrowers who lack full financials but demonstrate business continuity via BAS statements, bank statements, or an accountant declaration. We now support approximately 12,000 accredited mortgage brokers nationally, providing them with a consolidated suite of lending products. Our funding platform blends deposits and securitisation, including our capital relief prime warehouse with BNK Bank and a 500 million specialist residential warehouse with Goldman Sachs, enhancing our capital efficiency and recurring income. In early FY23, we made a fundamental decision to shift BNK away from low margin, low return residential assets. Instead, we pivoted into higher return commercial lending, targeted residential categories, and capital efficient structured credit investments. We set an initial goal of reaching 30% of the portfolio in these high margin segments. Today, we're already at 43%. This is a material uplift in the risk-adjusted return profile and is central to our structural margin improvement. This slide brings together the key balance sheet and margin dynamics that are shaping our earnings profile. Our loan book grew by 80 million during the half, led by commercial lending and the launch of structured credit and a more targeted residential strategy. This growth more than offset the strategic runoff of the lower return prime loans, resulting in a portfolio that's contributing more effectively to earnings. For context, first half 25 also included the sale of 220 million of low margin residential assets from the Bendigo warehouse back to Bendigo Bank. Turning to deposits, the funding base remains stable and is supported by a considered approach to pricing and mix, even in a competitive environment. This has been critical to protecting and expanding our margin. And importantly, net interest margin rose from 1.39% to 1.88% over the 12-month period. This chart shows the steady improvement in our net interest margin to a more sustainable range approaching our medium-term target. This uplift has been consistent across several periods, demonstrating the improvement is structural. We're now clearly seeing the benefits of our multi-year shift towards higher return segments and more deliberate liability management, with the portfolio earning more per dollar deployed as these segments scale. As margins normalise, further gains are likely to be more gradual. The current uncertain rate and macroeconomic environment will create both challenges and opportunities that will be carefully navigated to preserve and, where possible, improve the gains made to date. One of the most exciting developments in BNK's strategy is our entry into structured credit. In FY26 so far, we've made 3 senior secured investments into warehouses structures operated by established non-bank financial institutions, where demand for appropriately structured funding remains strong and often underserved by traditional providers. So what does this mean? It means for BNK that we can access diversified, high-quality asset pools, generate attractive capital-efficient returns, participate in the non-bank lending ecosystem, create a stable, repeatable income stream, and broaden earnings beyond traditional bank lending. For a microcap bank, this is a strategic advantage and a lever for scalable growth. So with that momentum, now let's unpack the key drivers behind this result and take a closer look at the first half of FY26 performance. Starting with the headline results, net interest income rose 5% to 11.6 million, supported by continued asset mix optimisation and more deliberate funding management. NIM increased to 1.88%, up 49 basis points in the first half 25. Net income rose 4% on the prior corresponding period to 13.2 million. Operating expenses were flat on a statutory basis at 12.2 million, despite ongoing inflationary, regulatory and capability uplift pressures. Turning to earnings, statutory NPAT was 0.42 million, up 31% on the first half 25. Underlying NPAT was 0.44 million, down 76% on the first half of 25. This reflects lower other income from reduced Goldman's warehouse originations, higher credit loss provisions, and targeted investment in resources to enhance capability, factors which together offset the improvements delivered in margin and net income. It's also worth noting that last year's first half underlying result included income from the robuster term transaction of the Goldman Sachs warehouse assets, which did not recur in first half 26. And as these transactions are normally lumpy, it creates a timing impact on the reported result. For the balance sheet shape, we recorded over 160 million of year-on-year growth in higher returning assets in the first half 26. This was deliberate, driven by purposeful execution to improve margin quality, reshape the portfolio, and focus on segments that contribute more strongly to earnings. So in summary, first half 26 delivered stronger margins, a modest statutory and underlying profit, and a strong capital base that supports the next phase of our strategy. Other first half key metrics not already mentioned, a strength of BNK's investment case is its balance sheet. Our capital ratio of 27% is up 21 basis points in the first half 25. Our liquidity ratio of 20.2%, which remains well above our minimum requirements, and net tangible assets per share of $1. Noting our underlying cost to income ratio was 92%, up from first half 25, reflecting the lower non-interest income that I earlier mentioned and higher employee expenses that we continue to invest in strengthening our capability and capacity. This slide connects financial outcomes to our execution. To summarise the half, high return segments reached 43% of the portfolio. Commercial lending grew 40% since June 25, surpassing 190 million. Structured credit capability launched with 3 transactions settled. Portfolio diversification was improved, and capital remains strong and supportive of growth. Our repositioning is working. This is now a structurally different business to what BNK was 2 or 3 years ago. This slide summarises the key value drivers underpinning BNK's medium-term path to stronger profitability, reflecting the progress now taking shape across the business. Looking ahead, these drivers support a clear and strengthening earnings trajectory. Firstly, continued expansion in commercial, selective residential and structured credit. Commercial lending is high return with good demand. Selective residential contributes to our higher return capital efficient mix, while structured credit is high return and capital efficient that complements our funded book, together strengthening the structural earnings base. Secondly, margin discipline and mix optimisation. NIM is trending towards our medium-term target of above 2%. Improved portfolio risk-adjusted returns is the third aspect. high return assets replacing lower return prime residential loans. And lastly, broader funding options. Our investment grade credit rating enhances funding flexibility and cost efficiency. Together, these levers provide a clear pathway to stronger and more sustainable profitability. So why invest in BNK? So let me bring the investment case together. BNK offers investors a completed strategic reset with a clear multi-year plan. Exposure to high margin segments not typically accessible in microcap banks. Growing commercial and structured credit income streams. A well-capitalized, well-regulated, conservative balance sheet. A diversified funding platform and strong broker network. A management team executing a disciplined turnaround. And a significant valuation disconnect. With an NTA $1 per share, BNK represents a compelling value opportunity for investors seeking exposure to a growing, capital efficient and under-recognised financial institution. And our strong cornerstone portfolio. This slide brings together the key indicators of portfolio performance and credit quality across the residential and commercial books as at 31 December 25. Firstly, the residential book, which remains our largest portfolio cohort at $732 million. The average loan size of $393,000 reflects a well-seasoned and conservatively structured portfolio. The portfolio remains highly granular, with modest individual exposures and a maximum single loan of $5 million, which is itself supported by a conservative loan-to-value ratio of 35.7%. This level of diversification limits concentration risk and underpins the resilience of the portfolio. Offset balances total $79 million, broadly stable compared with previous periods, and provides an additional buffer within the portfolio. In terms of arrears performance, 90+ days arrears stood at 1.37% off a small base, a total of 19 accounts. Importantly, 46% of customers remained ahead on repayments through the period. And as at the December half, we had one residential mortgagee possession case with no expected loss. Turning to the commercial book, the average loan size is around $600,000, consistent with a diversified portfolio of smaller scale property secured facilities. The largest single exposure is $3.2 million and is supported by good equity coverage, which reinforces the overall risk position of the portfolio. In terms of arrears performance, 90+ day arrears stood at 1.84%, again off a small base, a total of 4 accounts, with no mortgagee in possession cases. We continue active account level management with all our arrears cases, and with the commercial book, approximately 25% of customers remained ahead of their repayments. So across both books, credit performance remains stable and well provisioned, with arrears within board approved risk settings. So to conclude, BNK is a small, focused and fast-moving bank with a balance sheet, strength, capital adequacy and strategic partnerships of a much larger institution. Our strategic reposition is largely complete, positioning BNK to enter a period of scalable, margin accretive growth. The business is stronger and better positioned than at any time in its recent history. We believe the combination of the structural margin uplift, earnings diversification, strong capital, and a significant valuation discount positions BNK as an attractive opportunity for microcap investors. So thank you for the opportunity today to showcase the BNK business, and I'll now happily take any questions. Thank you.
Thanks, Allan. I'll kick off with a few. Maybe if we just start with the changing portfolio mix. On the slide that you had there, if you go back like 3 or 4 reporting periods, it's obviously changed a lot. Should we expect further changes in that, in terms of whether that might be another slice in the book of a new product coming in there, like structured credit has come in now, or should we just see more of the higher margin stuff continuing to be a bigger part of that bar chart, and residential kind of just getting smaller?
Yes, I think it'll be more the latter, Mark. Obviously, our focus will remain on allocating capital to segments that delivers the strongest risk-adjusted return. We don't have a fixed ceiling on that proportion of what that is. So you'll find that as the low margin residential loans, they'll continue to attrite. So over time, that percentage will actually increase through our organic efforts, plus also the runoff of the book. So for us, it's about, does the deal make sense? So we'll keep exploring opportunities across, our target markets and to see whether there's other opportunities there. But basically, the economics and the risk settings have to remain within our appetite. And it's really just a rinse and repeat strategy as we move forward. It's not about a set percentage, it's more about our asset mix optimization, if that makes sense.
Yeah. And in terms of dynamics in the market, and we can look at both sides of the balance sheet. Obviously, we've got the RBA hiking rates now, which I don't think most people would have seen maybe when you were presenting, I think, at the full year. Plus, we've had the introduction of the government's 5% level for first home loans. So maybe just give us a sense of where the deposit market has shifted now that we're kind of back in an interest rate rising environment, and what the impact of appetite for lending. I know you're not really in that low margin residential, but I mean it does kind of skew a lot of other parts of the market when it is going strong.
Yeah, it's a good question. I mean, the half definitely saw a dramatic shift in the interest rate environment, that was for sure. I mean, we've quickly pivoted from potential further reductions to now an increase. And in terms of our funding environment, that is definitely remaining very competitive. Customers are chasing high yield, both with at call accounts and term deposit business. We did see term deposits slightly increase as a proportion of our total funding through the period. Again, we've been very selective in our maturing term deposits. We're trying to deliberately rebalance liquidity needs with customer aspirations and expectations. It's all about actively managing the book. But yeah, there's no question, since the market shifted from a potential rate reduction to rate increases, we are seeing more liquidity pressure in the marketplace on deposits. That puts more focus on us to manage our deposit mix as carefully as we possibly can to continue to get that stability. We have deliberately targeted more at call accounts because we were in a rate decreasing environment. We thought we wanted to capitalize on that. Term deposits are great. It gives you funding stability, but they're the most expensive. So we try to find that balance. So as the market we're chasing yield, we've actually increased our proportion of term deposits as our total funding to give us a bit more funding stability, given competition for rates remains intense. And home loans, yeah, there's no question about it. They will continue to be under pressure from a competitiveness perspective. It's a race to the bottom of the barrel to some degree in terms of price, and that was what we deliberately have moved away from. We're not an organisation anymore that was growth for growth's sake, and that's where we were writing residential loans. We're now more purposeful. I'd rather do $100 million of business that's profitable than $1 billion that isn't. So definitely pressures on all banks to improve their cost of funds to keep up with the margin squeeze that's happening for new business prime home loans. Luckily, we're not necessarily playing in that space, and we're looking for more, margin accretive opportunities where we can get them. And we're still seeing margin compression and pressure happening on the commercial space. Don't get me wrong. That's become quite competitive in its own right as well. But it still gives us more margin elasticity and upside than what we're seeing on residential homes.
Maybe if we just talk about the deposits there a little bit more, it's kind of been around that like 1 billion, give or take. Should we kind of expect it to stay there if we look through on a year or two's basis? Is that kind of like where you kind of want to keep deposits and then, work on securitizations, warehouses, kind of other funding lines for growth on the in terms of the lending side?
Yeah, that's a good question. I mean, deposits is always a byproduct of your lending growth. So as the book has changed composition, and that's been the deliberate thing, the book is far more valuable now in terms of a yield than what it was from years before. And we've proven now that we can have a smaller book and still be profitable, rather than having a larger book and not being profitable, which historically was B&K's story. So deposits are really a byproduct of that, and making sure our asset mix and liability mix is right. So securitization is a possibility for us. Our first preference is to continue to originate deposits. So that will all get back to our growth aspirations. So I think the key drivers are there. We've demonstrated that high margin works. Our NIM is accretive to where it's been. It's going to be a rinse and repeat approach in that sense. And the more velocity we get for growing our assets, we'll have more need then for deposits. And if we get to the point where we feel securitization may be more efficient for us, also from a capital perspective, that's absolutely something that we will think about. We keep a close eye on the RMBS market and the CMBS market. I don't see a term deal happening for our residential book, but I think as we continue to grow our higher margin business, particularly commercial lending, I do see down the track opportunities for a securitization there as well. But our first priority is support our growth with deposits.
We, just think about the NIM moving forward. It's edging up to that 2% target. I mean, does it keep going from there, or do you think, given the product mix that you're in, it's a bit like, when you look at the big four banks results, the NIM, it goes up and down here or there, but it kind of tracks around the same level through time if you look at it on a kind of a longer chart. So should we see kind of B&K replicate that, get to where you want to get to, and then it just bounces up and down slightly around that level on a half by half, year by year basis?
Yeah, so again, it's all relative. So as we continue to be squeezed from a liability perspective, i.e. deposit rates, that plays into your NIM position. We've got to be very careful in how we price our assets to make sure that we want to reach our return on equity targets as well, return on capital targets. So I think it will be potentially more gradual as we move forward, to your point, in that we've undergone tremendous growth in our NIM from really what was an unsustainable number from some periods ago to being where we are now. Obviously, December was a 193 NIM for us that month in isolation. So I think we will hit the 2% target sooner rather than later. But I think given the volatility that's in the market at the moment with more global macroeconomic issues happening and the like, I think will probably be more gradual from here. But I still expect it to increase over time.
And then finally, maybe acquisitions, whether they might be, books, as you mentioned there, in the CMBS market, maybe potentially, or RMBS, people who decide they don't want exposure there, but you're happy to maybe take it, or something in the ADI or non-bank lender, bring it in under your wing, consolidated. Is that something we should think about as part of the longer term strategy?
Most definitely. I'm always in the market to look to acquire a portfolio if it meets effectively our investment hurdles. Most definitely. I think strategic partnerships are very important for me in that we can't be everything to everybody. And it makes good strategic sense to partner with someone who may have a different experience set in a different asset class from a distribution perspective, systems, experience within their business, etc. So it makes good sense to have those conversations. The structured finance, senior secured warehousing is part of that because they're different asset classes to what BNK originates today. So my first preference, I'll continue to look for those types of transactions. With all the channels we have, the actual senior secured is the most capital efficient of them all. We've structured that around APS 120, which is APRA's securitization rules. And that is even far more lucrative than writing a residential home loan from a capital risk weighting perspective. So a real priority for us is to continue to grow our senior secureds. If businesses aren't in position to be warehousing, they don't have that level of maturity and sophistication, I think then looking at distribution origination flows make good sense.
Allan, we're just bang on time there, so we leave it there. Thank you so much for coming back and giving us an update. And yeah, maybe let's chat late August, early September once the full year results are out.
Pleasure. Thank you again for the opportunity.
No problem. And I do know we have our second presenter. There he is, Stephen Lydeamore, joining us from Melbourne. Stephen, good morning.
Yes, good morning. How are you, Mark?
I'm very well. If you can just share your presentation, Stephen, I'll let you know once it's up on screen here.
Okay, is that showing okay?
Yeah, that looks good, Stephen. You can take it away whenever you're ready.
Very, very good. So thank you, everybody, for joining me today. It's a good time, actually, for me to be presenting. Last time I presented to Coffee Microcaps was back in, I think, September. And since then, we've undergone a strategic review and a change, and I'd like to outline that for you today. So I'll just quickly click through the safe harbor statement here. So our FY26 results have been reviewed for the half year, but not audited. And you'll see on this slide here, since the last time I presented, we've launched a new product. So we've launched a product licensed in from Sweden, Pro IBS, which is a European CE marked approved medical device for irritable bowel syndrome. So we've launched that into Australian retail pharmacy, which is expanding the product portfolio we have an offer here in Australia. You can also see an updated graphic for our Travelan flagship product there. The pack has changed and been modernised, and the pharmacy chains are very happy with that. We do have updated research available, so there's a link there through to our Investor Hub, which provides you access to that as well. And I've just updated the technology platform slide here to give better clarity as to what we have. So but I've explained to viewers before about our hyperimmune bovine colostrum, pointing out here that it's relevant to a broad range of pathogens, mostly bacteria related, not simply E. coli, which is what Travelan's based on. And IMM 529, which has recently been approved by the FDA, investigational new drug filing, which allows us to go into phase 2. These two assets, so Travelan, that's IMM 124E and IMM 529 for Clostridioides difficile infection, will both be seeking partners for each of those to fund through to registration and launch, so development and commercialisation licensing. And I'll talk a little bit more about that as we move through this slide deck here. So quick update on the status of affairs here. We have raised some capital late last year. So we raised some $7.3 million, which has contributed to the current cash balance. We currently have $10 million in cash, which sadly slightly exceeds our current market cap there. I think we were a bit oversold on that dilution there. I think we diluted our shareholder base by about 29%, but the share price has gone down by a lot more than that. And The price that we raised that cash at was on average in Australian dollars about 8.2 cents per share compared to the current share price of 2.98. So it's substantially below what I believe is fair value there. So just in summary, we are a commercial company selling three products on the market: Travelan in Australia, US, and Canada, Pro IBS, and Protectin in Australia only. And down the bottom there, you can see for the half year, we've continued that growth in sales. So we had overall growth of 5%. That was dragged down a little bit by Canada. Last year, we relaunched Travelan into retail pharmacy in Canada. So there was a load up of wholesalers. And at the moment, we're getting that stock out of wholesalers and into store and into consumers' hands. So that Canada's down year on year, which dragged down the overall results. Australia and US are both up double digits. So in Australia, 13%, and in the US, clearly the largest market in the world, up some 17%. So things are looking good for continued Travelan growth. And we, as part of this strategic reset, will be removing that cash burden and also the P&L effect of reduced R&D expenditure. The aim is to get to a break even sooner. It'll also bring forward monetization of our clinical assets, so IMM124E and IMM529. And I have a slide to show you here regarding the potential for types of deals there. So let's look at this clearer pathway to profitability. So IMM124E indication is for travellers' diarrhea, eligible for an end of phase 2 meeting with the FDA, and IMM529 recent FDA IND approval, ready to go into phase 2. So these assets are ripe for partnering. And under a partnering model, the licensee typically funds the development expenses, the registration expenses, and would launch and commercialise that in the market. In return for that, Immuron would expect to receive a licensing fee or upfront payment, milestone payments, which could both be related to development and sales thresholds, as well as a royalty on sales. And this removes that uncertainty regarding how would Immuron fund progression of both of these in the late stage clinical trials, and brings forward the monetisation of those assets. Look, we have cash of $10 million, and based on the half year operating cash flow, that represents just under 2 years worth of cash. So we're well funded to continue with the sales of our over-the-counter products as we work towards our path to profitability. And we continue to look for new products like Pro IBS, which we recently launched, to add to our product portfolio. Let's just have a look at the size of the market potential for each of the clinical assets we have. So IMM124E, if you look, you'll recall me talking about Lumati, a US market research consulting group, which estimated the market potential for this product in the US alone to be some US $102 million. And when you expand that to global markets, taking into consideration expected lower penetration rates and lower pricing in certain markets, it does bring up that total market potential to 188 million. So significant potential in excess of just the US alone. And for IMM529, this is our most valuable asset with the recent US IND approval that I just mentioned there. Lumati also had done an analysis on this for the US market alone, estimating the market potential of US 400 million. If you extrapolate that to the global markets, once again taking into account lower reimbursement rates in other markets like Europe, for example, it brings that total market potential up from the 400 for the US to some $650 million in global markets. So quite a sizable target there. And I've been asked by people when announcing our change in strategy of partnering earlier. So what are the likely deal terms? So it's very hard to say what they will be. All I can do is to give you some indication of deals done in the Clostridioides difficile infection space here, which on this table here. Now, you have to take a look at the stage of the deal. So clearly a product that's marketed has greater value than a product in earlier stage. So these deals range from preclinical through to phase 2 and phase 3 assets. Our IMM 529 is it's been through preclinical. We have first in man studies in. We also have FDA approval for moving into phase 2. So we're in that sort of phase 2 range, not the phase 3 or marketed range. But you can see here, even for a preclinical deal, there was a deal done with 50 million upfront. I'm not suggesting that we're going to get that, but this gives you an indication. And really, it's the beauty is in the eye of the beholder. So we will be appointing an advisor that will reach out to interested parties that would be interested in an asset like this, and we'll be seeking the best overall deal in terms of both milestone payments as well as royalties on sales. Let's just quickly move back for those that didn't see our half-year results. I've already mentioned the increase in revenue by 5% there. Australia up 13%, US up some 17%. We've maintained a healthy gross margin for over-the-counter product of 63%. And I mentioned that cash was up some $7.2 million that we raised in equity, cash of $10 million as of the 31st of December. Importantly for us on our path to profitability, we improved our EBITDX ex R&D. Let me just explain what that measure is. So, yeah, people will be familiar with what EBIT is. That's earnings before interest and tax. We're taking out of this as well the foreign exchange, which is an uncontrollable thing, which is greatly fluctuating at the moment with global events. And also R&D relating net R&D expenses. This is R&D expense and also less income. That's R&D tax incentives and grants associated with the R&D. So this gives you an indication of an operating P&L, and we improved that by $0.1 million in the compared to the prior year, but it was up from $0.7 million on the half two for last financial year. Graphically, you can see here sometimes pictures speak more than words and numbers on tables. So down the bottom there, you can see the contribution of Australia versus North America. And for the half year, we're more than halfway to what we did last year, which was a record year. And we're expecting continued growth in both Australia and the US, and also growth in Canada, not compared to last year, but quarter-on-quarter growth. And if you use a linear graphing method to track the trend in sales growth, you can see that picked it up on above there. So the growth trajectory for FY26 is a steeper slope than it is for FY25, and the projection is for continued sales growth in the second half to a new record sales for Immuron. This shows the quarter-by-quarter improvement in sales. What we are projecting here is that in the second half of our financial year 2026 and also overall that will exceed both the prior comparative period, PCP, and net sales, net profit, and the EBITDX ex R&D measure that I mentioned are all to exceed the prior comparative period. So projections for both top and bottom line are healthy, and we continue to see them improve as we move forward. I might just stop there, Mark, allowing time for questions that any viewers may have.
Thanks, Steve. I might just kick off with a few here. have you got any feedback on sales or response to the product, Pro IBS being launched from the pharmacy channel partners as yet?
Yeah, so we projected last year to be launching Pro IBS in the first quarter of 2026. We were able to launch that in October 2025. So we launched a quarter early, which is great, and we've got that into two of the three major wholesalers, and in the fourth wholesaler as well. So there's only one that we don't have yet. We started to get there's category reviews before we can get a new product onto shelf. You essentially have to displace someone off the shelf in order to get it on there. We've done that in a number of the smaller pharmacy chains, not in the big ones yet. So we're not in Chemist Warehouse or Terry White Chemmart. That's our challenge for this calendar year, to work on that. But feedback from consumers has been excellent, and those pharmacies that are selling are very happy with the progress to date. So you can buy it on our website, and I do encourage viewers to try it and see if it works for them. If you do suffer from IBS or any gut complaint that current therapies aren't working for you, give this a go. This is an EU, as I mentioned before, an EU-approved medical device indicated for medically diagnosed irritable bowel syndrome.
And maybe if we stick on the retail products, notwithstanding Canada, still a good half for Travelan overall, and just if we take Australia, 13% up. I mean, are you still confident you can get further sales growth in the Australian market, or where, in terms of where you think is the addressable market for Travelan in Australia? Where are we in kind of that continuum of the growth maybe starting to come off a bit versus kind of a solid every year we're kind of going to sell XYZ number of Travelan packs?
Yeah, so that is a good question. We did do the 13% growth in Australia, and that in of itself was somewhat constrained by events going on in the market. So you may recall that there was a merger between Chemist Warehouse, which is our largest customer, and Sigma. So essentially, Chemist Warehouse is now part of the Sigma Group and a publicly listed company. Part of the rationale for merger of those two entities, Sigma were their distributor, and now they're one. They have visibility down to store level of inventory. So whereas previously individual stores may have held 4 weeks stock of Travelan, and Chemist Warehouse used to have its own depots as well. Now they don't. So it's all Sigma depots. They have visibility down to individual stores, and essentially the stocking level, not just for us, but across all pharmacy products as a whole, have gone down from 4 to 6 weeks of inventory within the Chemist Warehouse group / Sigma down to about 2 weeks. So we've essentially lost a month and a bit sales. Just a one-off event, but it did affect that 13%. So that, if not for that, our growth would have been higher. I probably should show another chart here, which is the people travelling from Australia overseas, and especially when you break it down by destination. So people continue to travel to Indonesia, Bali, of course. But not only that, increasingly people are also travelling to Fiji, to Vietnam, to Sri Lanka, to India, all target markets for a product like Travelan. So we can not only continue to increase the penetration rate, yet the total volume of potential customers that we can go after continues to increase. So we're confident of continued double-digit growth in Travelan in Australia. And in US and Canada, because we're very early in the penetration stage, you would expect double-digit growth to continue in each of those markets going forward.
do want to just touch on it, maybe just as a reminder, Steve, because have had changes. On the tariff front, Trump's tariffs have been ruled illegal, whatever that means. The max is now going to be 15%, but he said 10% at the start. Who knows? But just in terms of North American market, moving stuff between the US and Canada, or moving stuff from Australia to the US. I think for everybody, just to give them a refresh on tariff impacts or not for IMC and travel and sales in particular.
Yeah, so they do affect us. So there's been a number of points on tariffs from the US government. There was one relating to pharmaceuticals where they're proposing big tariffs on all countries where the reimbursement rate in the other country was lower than the US, which is everywhere. That does not apply to us because Travelan is sold as a dietary supplement in the US. We have been paying a baseline 10% tariff. That's reflective in that 63% gross margin that we have there. And you're right. So the courts in the US have ruled that was illegal, for want of a better word. There's no guidance on whether any of that money will be reimbursed, and we're certainly not accounting for it in that way. There was a statement that baseline tariffs will be reintroduced at 15%, but have been implemented at 10%. So for us, we're planning for a continued 10% tariff on Travelan that we send into the US market, which we can cover in the gross margins that you're seeing on this slide here.
And the sale of the clinical assets, maybe if we move over to that side. In terms of, you're appointing an advisor, is that, kind of similar to, a request for a proposal? So, you kind of put out a deck saying we're looking to partner, people approach you, or do you kind of have a list of people you'd like to approach, and, they kind of help you work through who you need to approach, what they kind of need to see from Immuron side in order to kind of start a more formalized discussion? Maybe just give us an idea of how the actual mechanics of it would work.
Yeah, so we upon making the board making that decision, I've put together the one-page teaser, if you like, a non-confidential pitch deck. We have a data room set up. But the reason for appointing an advisor, so this is like small boutique investment bank type groups that are already familiar with the types of parties that would be interested in licensing an asset like this. So yes, we could do it ourselves. So we have a pretty good idea of which types of companies may be interested in a Clostridioides difficile infection asset. And that includes, as you can see on this list here, so it includes big pharma companies, but also because it's in that microbiome space as well, companies like Nestle, for example. So there's a broad range of companies that they could approach, but there could be global interest, and it's going to be a lot quicker for us to get to a deal if we use an advisor than to try and do it directly ourselves. So whilst people are willing, of course, able to reach out to me directly, we will be directing them through the advisor who has experience in such fields, knows the ins and outs of what's reasonable and expected, and the aim will be to appoint an advisor within the next month or two, and then to get a deal closed within inside of 6 months or so.
Okay, so we should watch out for it before the end of 26. We'll hopefully have some resolution to it. In terms of other work that needs to happen on those clinical assets, I know you're looking for somebody to fund the full phase 2, but is there any last bits of regulatory bits and pieces you have to kind of invest in, tidy up before that partner can come in and literally, okay, now we can start recruiting for the phase 2 study of however many participants that's going to be?
Yeah, so with regard to Travelan, we already manufacture that on a commercial basis and supply it in 3 markets, and it's manufactured at a pharmaceutical plant that's already approved by Australia, by Europe, and US. So it meets all the regulatory requirements for manufacturing. We've completed all the preclinical and phase 2 work. What is required is for someone to take forward into phase 3. So interestingly, the FDA put out some recent notices about relaxing the 2 phase 3 study requirements. So time will tell whether 1 or 2 phase 3 studies are required for Travelan, but certainly at least 1 will be required to be conducted by the party that we contract with. For IMM529, that's earlier in development phase, so we have not commercially manufactured that product, but we have manufactured it in GMP at pilot scale, and we know through manufacturing a Travelan that we can scale that up. So there is a little bit of work that we have to do, so there'll be some small amounts of R&D expenditure we have to do in terms of scale up and stability costs and things like that for that asset. But the heavy lifting will be done by the partner in terms of doing that phase 2 study. We do have a study set up ready to go in Australia. So we have an investigator, we have sites. We need about 60 patients. So we've got clinical protocols and all those things that the partner could take on board. More than likely, they would take that on, plus add their own sites in their own markets of interest, which would, unlike how Immuron was going to do it, would speed up the recruitment process. So we'd get to completion of that phase 2 quicker, which would be a good thing. But after phase 2, that would trigger a milestone payment to us, but then they would be required to go and do a phase 3, 1 or 2 studies before that was approved by the FDA, and similar for other markets like Europe, etc.
And I know we have talked about previously, or you have talked about previously, perhaps launching Travelan in the UK, looking at other products to bring into the Australian market, kind of like pro-IBS. As part of this kind of strategic review, where does those kind of initiatives now kind of sit as we kind of look to move forward through 26?
Yeah, so we still do have an interest in launching in the UK and Europe and other markets. And part of that strategic review is that we're now opening it up to not just launching it ourselves. So we will consider, even for the UK market, launching that through a third-party distributor marketer, not just Immuron. So the resources of other parties are obviously much greater than those of Immuron alone. So expect to see some updates on partnering, not only of clinical assets, but we're looking at partnering Travelan distribution in global markets as well.
Okay. And other products to add to the portfolio for Australia? Or is the focus
we have a few
on pro-IBS for this year?
Yeah, pro-IBS just for this year. Don't expect to launch any third-party products this year. There's a possibility of launching some line extension to Travelan that we would manufacture ourselves, but certainly for the next financial year, we would hope to be signing new agreements for new products, especially for the Australian market.
Okay. And in terms of, looking at the 3 markets that Travelan is in, also part of the strategic review, I think, you're talking about doing distributors in some of the new markets, but for the existing markets, is it still the board's view, your view, that we've got the infrastructure set up, they're running successfully, you're not going to flip those to a distributor model so that, kind of they're all the same, I guess, if somebody comes on board for the UK where you've got one on distributor, one you're doing yourself?
Look, for the US market, we would be open to doing something. We're primarily selling it via online channels, so Amazon and Walmart.com. We sell a bit into travel clinics, but it's pretty small. what we're not in is in retail pharmacy, and it's a big, heavy lift to do that, and we don't have the infrastructure for doing that. So we will look at potentially partnering with somebody that could take it into broader markets than the channels that we're currently in the US market. That would increase the breadth of selling opportunities in the US market from what we're currently doing. That said, just from where we are selling it, we do expect continued double-digit sales growth. So Amazon itself is now sells in excess of the largest pharmacy chain in the US market, but not more than all of the pharmacy chains combined, if you know what I mean.
Yeah, no, exactly. And people who've listened to you before, trying to get rearranged in Canada after you kind of lost ranging and stuff during kind of the COVID period was a large undertaking in itself. So trying to replicate that in the US market, which is probably 10x the size as Canada, would not be a fun exercise or a cheap one.
So there's obviously a lot more chains in the US market, and the price point of entry to get in, so the listing fees, and then the amount of money that you have to spend to on co-op for marketing spend to get them to keep it on the shelf is substantial. So that is something that would be probably better in the hands of a third party more so than Immuron.
Yeah. Steve, we are just up on time. Thank you very much for coming back and giving us an update. It was good to hear it, especially with the concluding the strategic review. And sounds like there's still going to be a few more interesting announcements come through the year. So yeah, we'll get you back in maybe later in the year.
Very good. Yeah, thanks again, Mark, and thanks everybody for listening.
Yes, thanks, Steve. And we are going to head out west to WA for our next presenter. I know Mark Waller from One Thick Group is there waiting for us. Mark, good morning.
Morning, Mark. How are you?
Good. Thanks for joining us early there in Perth.
No worries. Thanks for having me on. It's only 8:30 in Perth, so not too bad.
We didn't get you up too early then. Mark, I know you sent me your deck yesterday. If you want to share that presentation, I'll let you know once I can see it on screen here.
Hopefully you can see that by now. Yep.
Yeah, I can see that now, Mark. And I will just mention at the start, this was released to the ASX this morning. So please do check it out on the ASX announcements platform, and I'll let Mark take it from here.
Excellent. Thanks, Mark, and thanks for having me back on again. Okay. So One Click Group, we've been listed for about 3 years. We have a market cap of sort of hovers between $10 and $15 million, which is somewhere around 2x revenue for us. In terms of the shareholding of the business, directors own just over 20%. Half of that's me, so I'm the biggest shareholder in the company. And the rest of it's mixed between our chairman and the rest of the board. Institutional holdings, just over a quarter of the business now. So we've got 5 institutions on the register, with Thorney taking a substantial position late last year. On the board, Chairman Russell Baskerville, who's also the chairman of Bravura, is on the board of HBF and a number of other companies, and myself as managing director, and Nathan Kerr and Winton Willisey. A little bit on my background. Prior to One Click Group, I was the CFO of Empire Limited, which was a listed business between 2005 and 2017. Russell Baskerville was actually the CEO. So we've had a reasonably long working relationship. We grew that business from $2 million revenue and 20 staff back in 2005. We listed in 2007. Great timing, just going into the GFC. And that business when I departed in 2017 to start this business. That business turned over $180 million and had over 1,000 staff across, I think, about a dozen offices between Australia, New Zealand, the US, Singapore. So it was quite a success and was later then sold to Capgemini a couple of years later for $250 million. So a reasonable success story and an enjoyable journey with that business. So One Click Group. So One Click Group is a fintech where we have a platform which is called One Click Life, and the aim of that platform really is to just enable our customers to manage their financial life just straight off their mobile phone. And what we're trying to build out is a really well-connected ecosystem of products on the One Click Life platform to enable people that are in that lower to middle income bracket who don't necessarily have a high level of financial literacy to be able to pick it up, manage each part of their financial life, and feel as though they're in control of their financial life by using our platform. So we've connected to the Australian government in both the ATO and the Department of Attorney General, and all of the banks through open banking and health funds and a few other platforms to bring those products to our customer base. So where we started was with tax, online tax. And the reason we started with tax and what actually got me excited about this business initially was back in the late 90s when I finished university and started working. I started working in individual tax, and the process of how we lodged a tax return then compared to how my accountant was then lodging a tax return for me, 20 years later, was identical. In fact, the only difference was I was using a DOS-based software when I first started lodging tax returns, and they'd upgraded to a nice, pretty interface. So it looked a little bit better, but essentially it was the same task. There was zero innovation or very, very little innovation that had been brought to consumers in Australia. So accountants had a little bit of innovation, but not the actual people, people in Australia who are trying to lodge a tax return. We had upgraded from a paper-based tax return. So that was one massive innovation, but that was about as far as we got. The reason we like tax returns is, one, it was a very familiar area for me and the rest of the guys in the business. But secondly, you gain a lot of data about a customer. So with little innovation in that market, a big opportunity we saw to bring a product to market, which really put the power of lodging into consumers' hands, and the ability for us then to access a reasonably significant amount of data about that customer. We then added our next day refund cash advances. And one of the reasons we brought that to market was what we were getting from our customers is their refund was very important, and the speed that they received their refund was very important. So that next day refund product is a big differentiator for us against any competition in the market. None of our competitors are able to provide a product with the next day refund in the way that we can, and as simple as we can, fully connected into the ATO. On the back of the success of that product, we've just recently launched the Little Money cash advances, and we'll also be launching One Click superannuation, which I'll go into in more detail soon, later this half. And I'll just mention our mortgage broking business, which we launched a couple of years ago. That's just ticks away in the background. It's been very successful for us, just slowly building a nice annuity revenue stream. We started off with obviously $0 revenue in that part of the business. Last year, that was over 300 grand of revenue. And as I say, a nice steady state of annuity revenue just building in that business, which is great. At One Click Life, we own all our IP. So everything that you see on One Click Life, we've developed ourselves. That's been a significant journey. It took 3 years of working with the ATO to build the first online tax part of the product. And from there, we've just continued to build and build. We now have 230,000 registered users on the platform, over $6 million revenue, and we generated our first, albeit small, but our first profit last year. So a little bit of the next two slides are just highlights from last year. Last year was really a bit of a watershed year for us, recording our first profit in the business, which we were obviously very excited about internally, and really allows us now to grow without the need to go back to the market and raise money. And we have no intention of raising money in the near future to run the business. The only money that we need is potentially a debt facility in the future to expand our little money product. So in terms of our registered user growth, you can see from the chart on the left there, that's been fairly rapid. The business has grown really well. We listed in 2022, and we actually listed on $1 million of revenue then as well. So we've grown fairly significantly in that time as a listed company. And one of the reasons we wanted to list was to be able to put that money into the land grab that we saw available in terms of bringing customers or users onto the platform, and also the trust and the ability to ensure that our customers are comfortable with the fact that we're a listed company, we're audited, and we're not a private company dealing with their money. So that's enabled us to grow fairly rapidly. Importantly, that user growth is converted to revenue growth, and that revenue growth is now converting to profit growth. And I'll just explain the slide on the right, that trajectory through to our EBITDA of last year. Just one note is I've excluded share-based payments for that. And the reason I've excluded those is we actually cancelled about 90 million performance rights and 10 million options last year, so 100 million units, and reissued a very small amount of new units, which is why I've just excluded all of that from the calculation. So the revenue has grown, as you can see, reasonably well and slightly accelerating over the years. What that drops down to, the orange bars that I've dropped in there is our operating margin. And what that means is our revenue less our fixed operating expenses. And you can see from those bars, the gaps between them, the operating or the fixed expenses to run the business haven't really changed since 2022, right? So the year back before this chart. So from 2022, we generated $1 million of revenue, and that has continued. Those fixed operating costs have continued. We've had 20 full-time staff between when we listed and currently, and we're now generating $6 million revenue versus just over $1 million when we listed. What that's enabling it to do is that operating margins building year on year, and we expect that to obviously continue to build this year. And then less our marketing. Now, our marketing is all about new users, right? So there's a huge opportunity for us to increase the scale of the number of users on our platform. And for us, what we've always been trying to achieve is we have our tax product. People come to us for our tax product, and then they engage with our other products on the platform. And as we're bringing online these new products now, we expect to see that translate into accelerated revenue growth and accelerated profit growth as well. Our marketing spend last year was $2.3 million, and we expect to be around that, $2.5 million again this year. A few highlights in the last 6 months. These are all announcements that we've made on ASX last half. So the first one there is our July revenue of $3 million, translating to an EBITDA of $1.4 million in that month. And the reason I show that is twofold. One, just to demonstrate that at the moment, whilst tax is our predominant source of revenue, we are cyclical in that most of our revenue is generated from the period between June and November, so that 6-month block of the year. Also, then the second reason is just to demonstrate how scalable these the product that we've built is. So I mentioned that we only had 20 staff at time of listing, and we still got those same 20 staff. We do bring in a few casuals during tax time to assist with customer inbound queries. But essentially, what we're building out is a very, very scalable platform, a highly automated platform where people are getting instant response by the use of AI and chatbots to be able to talk to a customer, pull out their details specific to them, and present those in a format that makes sense to them. And as I said earlier, right, we're dealing with that lower to middle income demographic with reasonably low financial literacy. So what that demonstrates is where we are able to increase our revenue, we are able to turn that into a significant profit. Important to note, in 2022, as I mentioned, we only generated $1 million of revenue, right? We had the same expenses running the business. Now, $3 million in July is generating 1.4 mil of EBITDA. What we're seeing is every month in the following year, every month now is just stacking higher and higher and higher with our costs staying the same. So we're starting to generate more and more profit each month as we're scaling out that user base of the business. In 2025, so last year, and probably important to note, is we report on a calendar year basis. So when I'm talking about 2025, I'm talking about the calendar year. In 2025, we exceeded our 2024 full year revenue in only 8 months. We did the same the year prior and the same the year prior. So we've had a pretty steady, nice growth path with that tax revenue, where we're exceeding our prior year revenue in only 8 months, which is great. Our revenue for the year was over $6 million. We generated $0.7 million of positive cash flow in the second half of last year, and we expect that to be significantly more this year. And importantly, now our user acquisition costs are starting to drop. So I'll spend more time on this later in the presentation, but 2023, 2024, we were basically paying for every single customer that came onto the platform. 2025, now that has shifted to a significant number of customers coming to us organically. And the reason for that is the scale of our user base. So we're getting a lot of customer referrals, and the value of our website and our organic profile across social media. That generated over 60,000 new users added to the platform in 2025, which gave us over 230,000 users at the end of 2025. Very importantly, we also introduced another significant new product last year, which was our Little Money Cash Advance product. So just dialing back to tax and how tax works is what we're doing is taking connections from the ATO, Department of Attorneys General, and our health platforms and banking platforms, and representing all of that into a tax return that generates a significant amount of data for us. And look, from our side, that data is then very important in how we present additional financial products to our customers and how easy it is for them to be able to transact with us on for other financial products. So that data is really key to us and super important. From a customer journey perspective, what they see, so when we're looking at a new user signing up, they register, verify their identity, and we've got very sophisticated ID systems. Instantly, their tax return is completed to the point of knowing exactly what their refund is prior to putting their deductions in. They then have the option of manually adding in their deductions, or alternatively connecting their bank to the product, which will go through using our AI search for deductions and allow them to add receipts, and then hitting lodge. And it really is as simple as that. The whole process takes between 5 and 10 minutes. And at the end of your tax return, you then have the option of lodging and waiting a couple of weeks for the tax refund to come from the ATO, or alternatively, you can request that tax refund the next day. From an existing customer's perspective, obviously they've already ID'd, they're logging in, their tax return sitting there ready for them to go. And if they've been updating their receipts during the year using our receipt tracker technology, connected through their open banking, they will have a tax return sitting there ready to go, and just all they have to do is log in and hit lodge. So a really simple way to do your tax return. They have then the option of waiting the couple of weeks or requesting a next day refund. Now, that next day refund product is a huge differentiator to us, as is our receipt tracker and our open banking connections and the AI that we use to pull those tax deductions out to improve the refund for our customer. But that next day refund product we've had up and running for 3 years now. We've advanced over $10 million worth of refunds to customers. It's been hugely successful. And what we've had is a lot of customers then request a cash advance later in the year. So we had enough and quite an overwhelming demand from our user base, our customer base, to provide a product to our customers that they were able to use on an all year round basis, not just at the time of lodging their tax returns. So a couple of years of development later, we were able to build out what we've called our Little Money Cash Advance. What that's providing is cash at any time during the year that a customer needs it, as and when they have an expense that comes up that they're not expecting. That's repayable in 28 days through 4 weekly payments or 2 fortnightly payments. Now, that will depend on their wage cycle. So the repayment structure is tagged to when their wages are received. Our charge is a 5% establishment fee. There's no other charges thereafter, no interest or anything like that. The way that works from our perspective is a customer connects up their bank. We provide a financial life health assessment, then assess their credit. And what we do then is provide, or in the case of someone that's got poor credit, reject the application, and a customer just repays that as and when. Now, what this product is providing is a second revenue source for us, providing, a customer lodges a tax return, costs $99 for them to lodge a tax return. If they use this product 4 times during the year, we've just doubled our revenue from that customer without another dollar of marketing expense, which is obviously very exciting from our perspective. We have 230,000 users on the platform as at the end of last calendar year, 31 December 25. For us, the aim for this product is as quickly as possible, build up to 50,000 users using the product on a regular basis. Now, 50,000 users using the product on a regular basis generates about $10 million a year in revenue for us, so significantly changing the revenue profile of the business. And depending on the default rate, if we're somewhere between 1% and 3%, we're generating somewhere in the range of $2 to $7 million profit from the product. So quite an exciting prospect from our end. We're going fairly slowly with this product as we roll it out. So obviously there's a fair bit of risk lending off our own balance sheet at the moment. So we're just taking it step by step. We have $150,000 currently out from this product. We've had great feedback from our customers. We've built basically a fully automated product. However, at this stage, we've got a number of manual checks and balances in place. Once we're ready to go and we're comfortable with all those manual checks and balances that everything's working as we expect and want it to, we'll then push that into auto mode and roll it out fully, where we expect it to grow fairly quickly. So obviously we'll update the market on more information about that as and when we roll out additional changes and go to that automated phase. But that's a very exciting product for us and could be a massive game changer. Probably important to note as well, it's also demonstrating to be a good source of new customer acquisition or new user acquisition. We're seeing we rank fairly high for a lot of keywords associated with cash advance, and we're seeing a lot of new customers or new users coming to us organically through the website at the moment. So a fairly exciting product. Our superannuation, and Mark, I'm sorry, I know I'm probably taking a little bit too long here, but I've got about 2 more slides, so I'll race through those. Our superannuation product, That's taken about 3 years to build. Build's complete, which is really exciting. And the opportunity for us with this product is our customer base is predominantly hospitality, retail workers, warehouse workers, health workers. But you can see from just those top 3 occupations that I mentioned there, what we're seeing is a lot of our customers come from really transient workforces. And where people are based in really transient workforces, they often have multiple super funds, lost super where they've worked somewhere for a month, haven't provided their super details. And demand from our customers as a tax agent has been, what's my super balances? Where is all my super? What do I do with my super? So we built this product to allow people to check, find out where all their super is, find any lost or unclaimed super, consolidate that into a one-click life or one-click super fund, and then importantly, engage with that money on an ongoing basis. And for us, average user on one-click life is 33 years old. A 33-year-old Australian has an average super balance of 50 grand. So a pretty significant opportunity for us over that 230,000 users. I'll just skip through this very quickly, but we have a number of additional products which are smaller. The key 3 for us really is our online tax, that little money cash advance product, and when our super goes live this half, our superannuation product. And probably important to note, our superannuation is will make money. It costs 80 basis points for a customer. About half of that will come to us as a sub promoter of that fund. Just on our user growth, where we're seeing that user growth come from is we've hit a bit of an inflection point with our growth in that, as I mentioned in prior years, we had a significant amount of our growth coming from paid sources. We now have a really good mix and balance between organic growth, so call it free customer or user acquisition, versus paid growth, which is obviously exactly where you want to be. But what we saw last quarter of last year is our organic growth was larger than our paid growth, and we've seen that flow into this year as well. So we're seeing some really good economics around the cost of acquiring a new user and our ability to grow beyond that 60,000 users that we were able to grow last year. And Mark, I'll be quiet now, and I'm happy to take some questions.
Mark, we might start where you finished there, just on the super product, given its impending launch. I do see it floating around LinkedIn in a few places every now and again, but just in terms of unclaimed super at like maybe an industry level, or maybe if you've got it as a cohort of people, when you've been doing some of the back testing of looking at some of your users and the amount of multiple accounts that people have, maybe just give a sense of the opportunity for the consolidation of whether that's based on industry numbers or in your cohort of customer numbers.
Yeah, no, great question, great point that you raised there. So the lost and unclaimed super in this country is well into the billions of dollars. Based on what we see from our user base and the sampling that we've done across the user base, over 3/4 of our customers have multiple super funds, which is just a huge number, right? Completely blows me away. And nearly 20% of them have lost or unclaimed super. Now, that varies from anywhere from a few dollars through to tens of thousands of dollars. But there's a huge opportunity to assist our customers in, one, consolidating, so moving out of that high cost environment with multiple super funds, multiple insurances, so on and so forth, to a really low cost, easy to manage one-click super fund. And the ability then to help our clients find that unclaimed super, which is sitting with the ATO, and pull that into the fund as well. And the process that we've built for that is, well, the name of our platform's One-Click Life. So we've tried to get as close to one click as possible. Superannuation's a little bit more complicated from a legislative environment, but it's a few clicks through the screens to pull all that information in and then consolidate that into a one-click super fund.
And I know you mentioned there it's 80 basis points, which is, pretty competitive. And insurance within the product, is that part
Yeah,
of it as well?
absolutely.
And is that is that an additional revenue stream, or is that kind of captured in that like kind of 80 basis points is?
Yeah, so currently captured in the 80 basis points, which is a default super. It's probably important to note we're not a super fund administrator. We've white labeled someone else's super fund, and we're promoting that super fund. It's all built with one-click super investment, so we are one-click conservative through one-click high growth. But very important to note that it is very much a very low-cost product from our perspective, and we're just taking a share of the administration, that 80 basis points.
Squeeze in one more question. The 230,000, I know you said they're primarily that kind of transient, maybe more blue collar workforce. In terms of spread across the country, is it like representative right across Australia? I know WA based company and people from WA are quite patriotic, love to support a local WA based. But is that
So
230? I'm thinking about, from growth can come from, if you're kind of under indexed for New South Wales, for example, or Queensland, because
yeah,
you are kind of based in WA, maybe just give us a sense of it. Is it like right across the board, the 230?
yeah. So in terms of that user demographics, it interestingly just follows the population around the country. So
Okay.
WA, we're bang on index. We're actually overweight in Queensland, New South Wales, underweight in Victoria. So if there's any Victorians on the line, please, let your let the fellow Victorians know about us. But that's the only place we're underweight. Outside of that, it's pretty steady around the country following the population map.
Okay.
Yeah.
We'll squeeze in one more very quick one. Any indications so far of the cross-selling, I guess you can say, or how many of the users have kind of got some of these multiple products going? I know Super hasn't started, but who
Yeah.
have done the tax return, taken up maybe a small cash advance, and
Yep.
have done an inquiry on health insurance, and maybe not taken it up, but at least engaged with the offering.
Yeah, sure. So of our straight up tax returns that we lodge, at any year between 10 and 15% of those tax returns will use a next day refund feature. That was 12% last year. Of the people that have lodged a tax return with us, then converting into little money applications, that's been very, very healthy. So that's up to now 4% of our user base that have tried our little money product. That's without any marketing, right? So at this stage, we're just rolling that out very, very slowly. It's been it's been very high demand for that product, so we don't want to push it out too wide too quickly. And then in terms of our wills and health insurance, every day we'll have applications or new will being done. We're actually going to transition our wills. Wills are very, very much a one-off product, right? It's a $49 online will. We're actually going to transition that away from being paid to a free product with a focus on customer retention. We only generate about $5,000 a year of revenue from that product, so we want to invest that back into our customer base.
Yeah, exactly.
Yeah.
You don't want to grow the little money product too much and give your balance sheet a heart attack. So
As an
steady
ex-CFO,
as she
Mark.
goes. Mark, we will leave it there, and let's touch base maybe after the in the 4C, maybe in July, after the June 4C, once you've kind of got over the first month of tax reporting season.
Yeah, sounds great. Thanks again, Mark. Thanks for having me on.
Thank you. And then we will
See you later.
switch. Yeah, if you can just stop sharing there, because I do know we have Our next presenter, Jeremy Steele. Jeremy, good morning. Just take yourself off mute there, please, Jeremy. I can see the cover slide of your presentation. I can hear you now.
Great. Shall I kick off?
Yeah, you can take it away, Jeremy, whenever you're ready.
Great. Okay. Well, thank you for those joining live and anyone watching post today. Control Bionics is the business I'm CEO of, and I've been CEO of the business for the last 3 years. Control Bionics is a neurotech business. We have, a 20-year plus pedigree in the manufacturing and commercialization of surface electromyography, or EMG as the acronym is known. The technology is used in a variety of ways, and I'll explain what the technology is in a moment for those people who aren't familiar with it. But just to kind of set the scene of the business, as I said, Control Bionics has been developing surface EMG for over 25 years. We've got a very large portfolio of patents and regulatory approvals across the world, FDA, TGA, CE mark, funded devices in the healthcare space in all of those markets, and recently announced, or towards the end of last year, announced a partnership with Apple on integrating their brain-computer interface protocol with our technology. And again, I'll touch on that in a couple of minutes, some more detail. Our core business historically has been in the AAC, or augmentative and assistive communication market, which is providing technology to individuals with compromised voice. We've been at that for many years, and we're transitioning that business from direct to customer to a through distributor model, and we signed some recent agreements in the US on that. But I think where the business is going is a fascinating market potential for us on utilizing non-invasive neurotechnology in a variety of ways that some markets are already established, and some markets actually we're now creating uses of our technology that, whilst the science of surface EMG is well established in those particular markets, there's yet to be a device that really has the efficacy of our device. So we're pretty excited about the opportunities there. So just moving through, in terms of our core intellectual property and products, just to explain how EMG works, for those not familiar, anytime you move a muscle, that's generating electromyography, or it's generating EMG data, because to move a muscle, whether that be voluntary or involuntary, you're creating electrical activity in that muscle. And so EMG is the detection, measurement, and interpretation of those electrical signals. If you think about it in the simplest of forms, if I close my fist, the tighter I'm closing, the harder I'm closing my fist, the more microvolts of electricity I'm generating in that muscle for that to occur. And so the measurement of the level of activation, and indeed the intent. So to move a muscle intentionally requires you to think that, and we're measuring that intent, which is really along the same pathway of anyone else who's in the neurotechnology space, where that measurement, that detection and measurement of intent is what the technology is seeking to do. Neurotechnology is getting a lot of increased attention. I think in part because of the likes of Neuralink and Synchron, and indeed I would argue, it's as much the people that are backing those technologies that are bringing attention to this sector. But the advancements in core technology, the additive value of AI and machine learning and edge computing means that the adoption and the opportunity that this technology has in front of it is very significant, and something we're really excited about. You can see on this slide, that some of the drivers that I mentioned, But in terms of the segments where this technology is already being used and certainly can be used moving forward, there's a number of medical applications, human performance enhancement, and that can be from the rehab side as much as sports performance. And I'll talk about some of the organisations we're already working with in this space. Accessibility and communication, obviously, it's a market we're very familiar with. Consumer and enterprise tech and research and development. There's a lot of information on this slide, and this is available so people can dig into it if they want to. But just to give some context to how our technology sits versus some of the other neurotechnologies that are out there. If you take implantable BCI, which is what Synchron and Neuralink are doing at one end of the spectrum, we're at the other end in terms of the time, cost, and medical proof that's already established. Our device is commercialized and has been for many years, is already FDA, TGA, CE mark approved, is funded, and has thousands of customers that are already using it. So what does that mean for Control Bionics? Well, we're a single platform business. We are focused on how we utilize our expertise in surface EMG to deliver outcomes for our customers and the people that they're working with. The NeuroNode is our assistive technology device. As I said, this has been in market for many years and is towards the end of 2024, we received a HCPCS code, which it gives it $4,300 funding for anyone who qualifies for the device in the US, which has opened up a significant opportunity for us and the people that we work with. The NeuroStrip is our latest device, which is a miniaturization of our technology and delivering a kind of highly efficacious physiological data from the body, which allows the users of the technology to get muscle level insight that perhaps they've not had available to them before. You can see the markets that we're approaching and the customers that we're working with already. And then in terms of revenue streams, historically, we've been a one-off hardware sales business. Today, we're moving into recurring software as a service as people buy our NeuroStrip hardware and then pay for access to the software that allows you to extract the data from the devices and analyze it, develop protocols to ensure that you're delivering a kind of measurable outcome to your patient or your athlete. Just a quick financial overview on the half. We announced this last week. Revenue for the half was consistent with the previous year. As we reposition the business from a retail to wholesale, our focus is on reducing the number of customers that we have and increasing the total revenue and indeed the margin that comes from that. We had strong support from shareholders through the half, raising over $5 million and had a cash balance of just over $3 million at the end of 2025. Kind of big milestones for the half. We acquired the balance of Neuro Elite Athletics, which is part of our sports performance business that we didn't own right at the end of calendar 2025. We announced our collaboration with Apple, which is a really exciting opportunity for us that I'll spend a couple of minutes on shortly. And obviously managing how we spend our raised capital to ensure that we are growing our top line in a kind of well thought out manner. In terms of our NeuroNode distribution strategy, as I said, the granting of the HCPCS code, which is the first new code in assistive technology in 13 years, to give you some sense of how rare this is and how good the opportunity is. On the back of that, we've worked with a number of potential distribution partners in the US and signed 2 in January to give us really probably the 2 largest. I mean, Tobii Dynavox is the largest player globally in this market. They've signed an initial what's been described as a 6-month pilot across 5 states. the way I think about it is this is the first rollout of what we expect to be a US-wide initially rollout, and hopefully into other countries as well. Tobii Dynavox, to give you some sense of scale, we have 4 salespeople in the US. Tobii has 150. So we're confident this is going to be quite a substantive opportunity for us, and we've spent much of 2025 gearing ourselves up to be able to support what is a very significant organisation, and training and implementation is well underway for Tobii. PRC Saltillo, again, a very significant player. They have about 75 salespeople across the US. They've already commenced selling our device last year, and we just put in place a formal distribution agreement as we continue to roll out to their sales force. Just this week, we announced, this is fresh off the press, that we were granted German HMV listing to ensure insurance coverage in Germany for both public and private insurers. Germany is the second biggest market in the world for assistive technology. This is a really meaningful opportunity for us. Again, not something that's easily granted, but something that once you get it, really underpins distribution relationships. It's not our intention to open up an office in Germany, but rather to work with the already established players as an addition to the portfolio of technology that they're using. The beauty of the Neuronode is that there is no comparable products. We have patents that still run another 16 years over key parts of our technology, and so the benefits, the clinical benefits of utilizing a Neuronode in assistive technology is already well established, and so getting insurance coverage and having the protection of the intellectual property gives us the confidence that Germany will be a very strong market for us, as the US already is. In terms of the NeuroStrip, so this is our newest technology. You can see in that middle photo, I mean, that is the device attached to what looks like the VMO. In your quads, you have 3 main muscles. What our device allows us to provide to customers, whether that be a strength and conditioning coach or a rehab physician, is muscle level insight that they're currently not getting. Without going into too much of the science, perhaps just accept at face value that this level of muscle insight gives clinicians and trainers an ability to really, understand what is going on in muscles and how the level of symmetry or asymmetry that might occur between individual muscles or individual limbs, but also give the person who is wearing the device a level of insight into what activation is going on. In the simplest of ways to think about it, anyone is only using something between 40 to 60% probably of their muscle capacity at any one point in time. This technology allows you to understand how much you're using, and if you follow the protocols that we've established inside our technology, you can increase the level of activation that you're generating, which, all things being equal, will make that muscle more effective and more than likely reduce the risk of injury. You can see down the bottom, these are a selection of the customers that are currently already using the technology. Ohio University is a D1 college in the US. They have 500 athletes join their program every year. They're going to use they are using our technology to profile each of their athletes when they come in, to understand the level of activation in their muscles, particularly leg muscles, where most on-field injuries occur unless it's a freak injury. And so this is a way in which they can understand activation and ideally prevent injury or support strength and conditioning programs. Stroke Lab in Japan, one of our first customers, are using our technology to assist patients in rehabbing the limbs that are affected by a stroke. One of the impacts of a stroke often is the neurological connection from the brain to the muscle is broken or is weakened, and so utilizing this technology helps both the clinician and the patient reactivate, recreate those neural pathways, which will then deliver the rehabilitation thereafter to get the strength back into the affected limb. We also announced last week a new kind of capital light opportunity for us. Again, in our focus to be a distributor-led business, we've signed a joint venture to manufacture some iOS-based speech generating devices in the US. This is quite a large market. We estimate the total market to be more than 5,000 devices. Apple devices are sold into this market a year. Think about the customer being schools as an example, where they're assisting children who have developmental issues, and so whether that be autism or ADHD, and providing specialized technology to them to help them educate, learn language, and communicate with people in their lives. This is a well-established market. We're working to sign up a number of distributors. We're in kind of detailed negotiations with potential distributors to sign LOIs that total more than 1,000 devices a year. Those devices are funded to the tune of $6,000 to $7,500, and we will be selling to them obviously at a wholesale price with good cash generative, working capital positive dynamics for that. It's a really exciting opportunity. We expect we have to go through some regulatory approvals that are well underway. If all things go to plan, then we should see first sales of that before the end of this financial year. If you were to look at our business today, you would see very much a focus, or solely the focus, on our AAC business. We are and have been working really since the end of last year on a strategic repositioning, really to reflect the conversation I've been having today in the way in which we engage with shareholders, the market, customers, our staff. That work we will come out and announce to the market probably in 3 or 4 weeks' time. Just a clearer articulation on the priorities of our business, and that's very much focusing on Neuronode, the NeuroStrip, and its neurotechnology use cases, and then the platform opportunities that the partnership with Apple and with others that we're working on afford us. When we come out and talk about that, there will be no new information in terms of where we're looking to take the business, but it'll be very much a presentation as to the way in which we engage with the market and stakeholders in the broadest way. And as I said, we expect that to be delivered to the market towards the end of March. And that's really that's me racing through in about 20 minutes. So appreciate there's a lot more behind this, and happy to take questions. And indeed, my details are on the presentation if people ever want to call me up or drop in and see the technology live. We have operations in Melbourne and Sydney and in the US as well, and always happy to meet face to face.
Jeremy, yeah, thanks very much. And yeah, just to reiterate, I would say, as well as Jeremy's contact details, keep an eye out on the ASX for that shareholder update at the end of March, because it sounds like it's going to be quite an important one. And Jeremy, just a few questions in terms of the Neuronode, the capital light project that you're going on. Should that kind of pan out the way you expect it to over the kind of course of 26, is there scope for other similar type projects, to be done off the back of this one? Maybe not in the same space, but kind of working off the same model.
Yeah, I mean, I think so. What is clear to me is that we are really, really good at technology, and we don't have the scale to be really good at necessarily the retail of that technology. And so, our focus is very much leaning into let's create value for shareholders where our strengths lie, and that is in dealing in volume, in dealing in surface EMG. And so what does that mean in terms of other partnerships? Then yeah, I mean, if it is consistent with that, playing to our strengths, then we will certainly do that. I mean, I think where we're likely to see that next is probably in distribution arrangements for NeuroStrip and the technology. So that kind of context of platform our devices are generating an extraordinary amount of high quality physiological data that has applications that we can't even imagine today. And so creating that platform, allowing other people to integrate with our technology and use those signals for whatever purpose they want. I think that's really where we can get scale quickly. Is as an example, the Apple BCI integration creates an ability for a developer to develop an application on the iOS framework where they're utilizing strength of intention from an individual to create a game, to create a manufacturing product, to whatever that might be. And I think that's where we can get scale extraordinarily quickly by someone else using our technology to build something on top of, and that's work that's well underway from us.
Yeah, I mean, further to that question, I have it written down here. Obviously, being listed on the ASX, people are probably familiar with the Catapult guys, but I mean, they're dealing with like athletes, but from a different kind of perspective. But they're also the data that they're generating is being used to manage return to play protocols, manage loads, manage minutes, whatever way you want to say. I mean, is there potential for you to partner with the likes of Catapult, other competitors that they have? I mean, they're not the only provider that GPS tracking stuff for athletes. I mean, is that something that, further to what you were just saying there, possible where you're interlinking your data with somebody else who's also, tracking kind of athlete performance?
Yeah, I mean, look, absolutely, and I think the point that that's well worth making is, this data is not looking to substitute what people are already doing, and we're in talking to all of the teams you would expect us to here in Australia, AFL, NRL, basketball, and they're all using that technology because it does give great information to both how do I get my athlete to perform better, but also how, if they're injured, how do I get them back? I think what we're doing is we're providing a level of insight that they're not getting from what their existing tools are giving them. So this is about adding to the information. There's some really great case studies we have where you may see something in utilizing some of this technology that you thinks that everything's okay in a particular leg muscle, and then you then use a neurostrip to isolate a particular muscle and actually see, because what happens in everyone is that if you injure a muscle, your body compensates, and so other things work to try and shield where you're injured. But the problem with that is if you can't see what's going on there, then you're likely, firstly, an athlete says, well, I'm good to go back on the field or back on the court. And then the likelihood of re-injuring is high because they've not rehabbed to the right level. So yeah, those partnerships make a lot of sense. And I think particularly because it's just more insight than what's currently available. And I would say almost without exception, everyone is really keen for surface EMG data. They've just not seen a good enough device at this point.
Okay. And I do just want to touch on the Germany announcement that came out was it yesterday or the day before? In terms of getting that reimbursement, I mean, just to give people a sense, I mean, how long has that kind of been in the works to actually kind of get it over the line and get it approved?
It's about 9 months.
Okay, so, and should we expect similar ones for other markets? Is there a process ongoing in, I don't know, France or the UK or Italy?
Yeah, I mean, every market, frustratingly, every market is slightly different. I mean, in the UK, we're already funded, so that's fine. There are other markets. France is a pretty interesting market. Scandinavia is also kind of well funded, but not particularly big. I think for us, the focus is let's do the markets. We always wanted to get into Germany, and we have talked about it. But let's deliver on the markets that we're in before we expand, too much further beyond that. The other German-speaking countries, so Switzerland and Austria, are a natural progression for us. Indeed, because the people that we will work with in Germany are also in those markets. So, the advantage for us in kind of building out our, let's call it, regulatory support is the big distribution partners we have in the US are also the big ones in Europe. And so it's a natural flow on that, Toby, PRC, Smartbox, any of these guys who are using our technology now, now that we have funding, it's a very easy add-on for them.
And the newer strip in terms of getting new customers, I know we talked about Catapult and others as being potential partners, but in terms of rolling it out, say like Ohio, but like getting that, I know Catapult, as part of their growth strategy, they were very big on getting whole leagues signed up. So it would be like the whole of NCAA, track, or NCAA like field hockey. Is that kind of the approach going forward? So rather than trying to get individual, colleges, it's like, let's get a particular sport at whether it's D1, NCAA, AAA. Is that kind of the plan?
Yeah, I mean, I think in the fullness of time, that's right. I mean, what we are seeing is and I think part of this is driven by what Catapult did to the market as far as creating such value for the insight their technology delivers. Is people are now looking for a technology edge. So the number of kind of conversations I've been in with customers where they say, can you just work with us and not work with our competitors? Because everyone's looking for that edge. We've been to an AFL team here who I won't name, who said, their position is they want to be sports tech leaders for the AFL. So, they're almost kind of, and look, AFL is a tricky one because there is a lot of control from the AFL head office. But I think, look, I'm of the view that we need to continue to build our evidence base of the value that people are getting from this and the commercial realities, the commercial model for us. And at some point, those league-wide opportunities will come up, and of course, we will chase those. But right now, it's let's work with the people who are really hungry to be leaders in the use of this technology, and we'll support them and make sure they have a wonderful experience. And I think that will just drive revenue growth. I mean, the US market for sports technology it takes your breath away as to how much money is being spent in colleges and even prep schools. We've got prep school customers who have a technology budget bigger than any basketball team in Australia, as an example.
Yeah, no, I mean, it's I read an article on it just the other day, the professionalization of like even high school sports, like how serious top level high school is now, and not just in the States. I mean, it's starting to become a feature around the world. But
we're working with basketball teams at high schools in the US who charter planes to fly their kids around to play a basketball game on a Friday night. I mean, it's just you can't imagine how much money is being spent. So yeah, we want a piece of that action.
Yeah, no, exactly. Well, I mean, I know just from South Africa, you can watch all of the high school games on their equivalent of Fox Sports, and some of the big games have bigger crowds than you would get for some of the Super Rugby games in Australia, which is also crazy.
Indeed.
Jeremy, we leave it there. We're just up on time.
It.
Thank you so much for joining us, and hopefully we can touch base later in the year.
Sounds good. Appreciate it. Thanks, mate.
And we will hand over. I know he's been waiting there very patiently. Patrick Bodegraven from the new CEO hot seat there at Orcoda. For some of our regular people, we have had Orcoda on before. Previous CEO Jeff Jameson has presented the Orcoda story, but Patrick is going to be talking us through the story this morning.
Hi, Mark. Good to be here. I presume you can see everything.
I can hear you, see you, but I can't see your presentation as yet. Hasn't come up on my side, at least.
Give me one moment.
It's loading now, Patrick.
Excellent.
Yeah, I can see the deck if you just want to go to slideshow mode, just so we get the full screen effect.
Oh, with it. We're okay?
No, we have we're stuck still in preview mode, if I can say that.
Oh, okay, just give me a moment. How's that?
No, we're still in preview mode. Oh, there we go. Now
Okay.
I don't know if that's the cover slide or you've skipped on to the contents one. It says slide 3 here, but yeah, there we go. We're
Okay,
on the cover slide now. Thanks, Patrick.
Thanks, Mark. Good to be with you, Mark. What I'll do today, I'll give you an overview of Orcoda, a snapshot of how we've got to where we are, and then I'll cover our highlights and give a business overview, and then we can take some questions. So Orcoda is an integrated transport software company. So we're involved in moving passengers, workers, and goods using our transport management solutions. We also have capability in transport infrastructure contracting services, telematics, which are the devices that you can put into cars so that you can track them, and AI cameras so that you can look at drivers to examine their driving standards and behavior and make corrective action. And we're a well-funded listed company. We've got about approximately 4.7 million in working capital, comprising of about 2.6 million in cash. And most importantly, we've got 5.4 million in annual recurring revenue, and that's across our two key software platforms that I'll speak about shortly, which are Transport 360 and Contractor 360. Before I get onto that, I'll just give an overview of the board and key management personnel. And Mark, you mentioned that I'm new, so I might give a little background about myself. I've been in the IT industry and consulting industry for about 30 years, and I joined Orcoda midway through last year with the plan to become the CEO and managing director. So I worked very extensively over the 6-month period before I moved into the role with Jeff Jameson, who was the previous MD for almost 10 years. Jeff's moved into the CFO role, which I'm greatly appreciative of. So I've got Jeff there to help with corporate knowledge and any other transition activities as I settle into the role. But I'm feeling pretty settled and enjoying it so far. Rounding out the board, we've got Brendan Mason. He was the CEO of Orcoda prior to Jeff, and he's the chairman. And between the three of us, we've got extensive corporate knowledge and good, I guess, contingency in that we've all been very experienced, well, particularly Brendan and Jeff with running the firm. Key management personnel, most of the folks down below have been around for about 10 years, with the exception of Mark Austin. He joined the same time as me, and he's been brought on to really try and grow a new and focused part of our business around workforce logistics and IT services, which I'll cover shortly. So the vision has always been for Orcoda that we want to be a full intelligent transport provider, or have an intelligent transport management system. So that comprises of the software in terms of being able to book workers, passengers, and goods onto transport infrastructure, and then the actual management and delivery of those workers, passengers, and transport. So the company was initially founded by the merger of Resource Connect and SmartTrans, and that was done in 2018. Then a couple of years later, we acquired the Better Group, which is an electrical and infrastructure contracting company that focused on smart transport corridors, has good capabilities in road and rail, and that enables us to connect our software with actual infrastructure. And then the final acquisition we made in 2023 to round out our ecosystem of offerings was FutureFleet. And FutureFleet's a provider of fleet management solutions and telematics. So this enables us to connect with the vehicles, tracked vehicles, and as I said, it rounds out the ecosystem to produce the intelligent transport management system that we have now. So if I move on to the highlights, it's been a great half for us. As you can see, we're up on all the key metrics. Our revenue's up by 2% to 9.7 million. We had a rough patch in the previous reporting period where we had some deferment of large projects that put a hole in our revenue, but we are recovering well from that. Our underlying EBITDA is up by a massive 130%, and we've increased our net profit after tax, or reduced the loss, I should say, by 63%. And as I mentioned earlier, the key metric there that I'm most proud of is we've increased our annual recurring revenue up by 20% to 5.4 million. Again, that's across our Transport 360 and Contractor 360 platforms. So if we go into detail about the operations, we've got two operating divisions. We've got Transport Technology and Resource and Infrastructure. So the Transport Technology is where we have our FutureFleet organisation and our Transport 360 software. So Transport 360 is a proprietary SaaS software. We've had it in place for about a decade. We've got a good R&D program where we're making enhancements to it. At the moment, we're looking to infuse artificial intelligence into the platform around developing a large language model that will provide agents so that we can make updates to schedules and bookings without human interplay, and that can be done instantly to produce efficiency. The division itself made 3.2 million in revenue and good EBITDA. We operate across quite a number of different customer segments, as you can see: transport, community transport, pathology collection, food and goods delivery, mining, agriculture, and the like. We've got some of our customers there, but our largest customers are Savins, Nicoletis, Pathology, Transit Care, and Northline. If I move across to our Resource and Infrastructure group, this comprises of our Contractor 360 software, which I'll speak about in a moment, and our TBG division, and beg your pardon. And we've seen a growth of about 40% in the revenue of this division. And I mentioned earlier, we have a focus on Contractor 360. We've had it as a product for a number of years, but we've really revamped and modernized it now, and we're actively taking it to market. And I'll spend a bit of time on Contractor 360. So it's a platform that's really about the mobilisation of workforces, particularly mobile workforces. So it's directed towards the mining, resource, and construction industry. And if you can imagine large projects where you have fly-in, fly-out workers, Contractor 360 manages the whole mobilisation process, from ensuring that a worker has the right credential, they have the licence that's required, they've had a drug test, a medical test, their flight's been booked, and they have accommodation booked before they're deployed on site. So when I joined Orcoda, it was news to me, but quite often on large mining sites, for example, with fly-in, fly-out workers, you have situations where you might have a team of, say, 15 electricians turn up, and someone has not booked accommodation for them, or some of them have expired credentials. So they've come out to site and they can't work. So it creates a delay in the project, obviously, which is very, very costly. And most of those folks, the electricians in this case, are on TNM. So they're still being paid a daily rate, and they may need to be flown back if there's no accommodation, as an example for them. So what Contractor 360 does is it works as a backbone and integrates all the various systems that might be in play. Some of those systems might be paper-based or spreadsheet-based, and it can replace those processes, but it integrates them into a series of gates to make sure a worker can't proceed to be on site until all those activities have been completed. So we avoid the situation where you have someone turning up who can't work. So the ROI, return on investment, on Contractor 360 is very substantial, and we're looking to deploy that, as I set out, into our mining resources and construction clients. So I guess, Mark, that I thought I'd leave more time for Q&A, but just in summary, we've had a great first half. All the metrics are positive. Our annual recurring revenue has increased substantially, which is what we're all about. And we've got a very strong pipeline of opportunities in the second half and beyond. So happy to take questions.
Yeah, maybe if we start where you finished, Patrick, on Contractor 360. In terms of the revenue model for it, is it a pure, SaaS offering where, it's a system, somebody's using it, it manages, the demobilization of teams for, one team is finishing one swing, another team is coming in to do the next swing, or is it that plus how many people you're actually, you had your 15 electricians there, but if we're talking about, getting in the whole production mining team, you could be talking about 200 or 300 staff moving in and out at a time. Maybe just give us a sense of how the actual revenue model works for it.
Yeah, sure. So, Mark, it's very scalable, so it can be accommodating thousands of workers on different projects. We generally charge on a per worker basis. So that's the model. It covers all the elements that you mentioned. There are additional things that we can connect into it. So it's a system that it's not like we're putting in SAP or Oracle or a big ERP like that. What we do is integrate with the systems that a client might already have. So it's not a big implementation. It can be up and running pretty quickly, but it integrates all those disparate systems to make sure that you've got a chain of activity that doesn't get broken, and that you get the workers on site when you need them, and they have the right credentials, accommodation, and the like booked.
I know from the tab you had there in terms of the revenue splits between the two divisions, it's the bigger of the two. Is that a function of the total opportunity, or is it just that the 360 product has kind of been a focus at the minute, and it's been getting good traction, but we shouldn't forget about the transport product. It's also got a different opportunity set, but maybe the sales cycle is a bit longer in it.
Yeah, so the Transport 360 software has an equally long heritage, and there's a lot of IP obviously built into it. We've got over 20 clients that are using Transport 360, and they range in size. What we're seeing is good growth around community transport. So these might be not-for-profits who are picking up an elderly person, taking them to medical appointments, taking them to hospital, taking them shopping, and our software manages all of that. So we're seeing very good growth within our existing client base, and we're also seeing good growth with new clients. It's interesting, there's been situations where some states have been mandated to use a particular type of platform, and indeed they've been subsidized by the government to use them, and those arrangements are finishing. So we're getting a lot of those clients now coming to us saying, hey, what we've been using has been kind of free, but it hasn't been fit for purpose. Now that we've got to pay for something, we want something better. So we're seeing really good opportunities there, particularly across New South Wales. And there's quite a few live opportunities we're pursuing.
And the revenue model for Transport 360, does it follow the same setup as Contractor 360?
It's on a vehicle basis.
Yeah.
So we charge a monthly fee per vehicle. Generally there'll be implementation and consulting work, up front that might be 10 or 15% of the total contract value, but then it very much comes into the annuity model of software licensing as a SaaS product.
And I mean, if we look back at the history of Orcoda, as you kind of touched on in your slides, it's been a few acquisitions plus, a bit of, I won't say a bit, a lot of like internal R&D to fit these all together and create the ecosystem you have. From your perspective as kind of the new CEO coming in, should we expect more acquisitions in the future for, whether you want to deepen integration on a horizontal basis or get more vertically integrated? How should we think about, acquisitions, given they have been part of the Orcoda story historically? Do they sit in the future as well?
So just a little bit of background. When I joined, I was doing some other work with Jeff and the board in relation to another particular business venture. And the more I started to learn about Orcoda, the more I realized that it was a full product set. And I've got a background in software and technology, and I was very impressed with the tech. And actually, I instantly invested in the company personally, and now I've ended up joining, which is terrific. But I think we're done with major acquisitions in terms of particular capability. I think we've got the capability that we need. There may be small acquisitions that we'll look at to give us a footprint in a particular area, but I'm certainly not seeing any significant acquisitions on the horizon. I can't see any reason why we'd be needing to do a capital raise or anything like that. As I said, we're self-funded, and we've got what we need to be successful. But never say never. If something comes up, as they often do, we'll assess it and we'll make a call.
Yeah, exactly. And in terms of giving yourself funded, capex and money that goes into R&D, because I know a lot of these platforms, especially customers, they want every single bell and whistle under the sun and customized to, their kind of workflow, and you're trying to maintain an overarching system that kind of works for everyone. How do you think about, I guess, spending money on R&D and growing it out? Do you look at it as a function of revenue, or we have you set a budget to start of the year saying we're going to spend whatever, $400,000, $1 million, and it's that is the budget for the year, and we got to try and achieve as many projects as we can from that pool of funds?
Well, we have a user group set up with our key clients, and we get their feedback on what sort of functionality they're looking for. I mentioned the AI agent being able to do automatic scheduling and booking, and that was one thing that our clients are looking for to reduce their headcount. So we'll set a budget and what our projects are at the start of the year. We're very tied in with the government R&D program as well. We got 300,000 reimbursed last period, which is all goodness. But that's how we determine what the R&D is going to drive in terms of product enhancement.
And I mean, this last half, EBITDA positive, trending towards full, proper NPAT positive, hopefully, let's say in the not too distant future, depending on what happens with some of the sales initiatives. Does the board envisage continuing to reinvest for growth, or does dividends could start to come into the picture? Because you talk about the board there. Basically the two founders are very long-standing founders and shareholders have been involved there. So I'm just trying to get a sense of once you cross over that NPAT profitability, what does that then entail for capital management levers that suddenly become open that are not kind of open at the minute?
Sure. So I think there's more investment that we need to do in sales and marketing and product initially before we look at dividend payments and things. I'd certainly like to be in a position as a software company. We've got the annuity revenue coming in, that we would get to that point in the future. I'm not sure when we might get to that point. But, as you've alluded to, the key priority is getting to a sustained profitability, which I don't think is too far off.
No, exactly. I mean, from the slide you showed there, I mean, I think it was 63% reduction in the loss. So, a few more halves of that, and you'll be well on the way to it. In terms of breaking into other sectors, I know on the contractor 360, I think you listed them there, infrastructure, utilities, government, not-for-profit. Is there any others that you think you could move into? I'm thinking, in the event space, where you've got these huge big festivals, loads of people coming on site to set up, break down, actually involved in the day. Or if it's some of these multi-day festivals, you've got staff who are actually working at the festival, but they're not really involved in the setup and breakdown. But when you add all those people together, it's quite a large number of people for some of these big events.
Yeah, correct, Mark. So you look at something like the Olympics coming up in Brisbane.
No, exactly. Yeah.
For us there. So yeah, it's anywhere where there's a lot of workers coming from different places who have different credentials and licensing requirements, particularly if it's remotely, that we can really add value. So, you've mentioned mining resources, construction, but there's also, utilities. There's opportunities in defence around government, bases and mobilisation associated management and the like. So, those types of functions exist across a number of different industries, both here in Australia and internationally, which is where I hope to get to one day soon.
Yeah. Okay. I'm just going to double check if we get any further questions. I don't think we have. No. Patrick, we might leave it there. Thank you very much for coming in and joining us this morning. Well, this afternoon, I should say now at this stage. It was good to get an update, and yeah, best of luck in the new role, and hopefully we can catch up with you later in the year.
Okay, thanks, Mark.
Thanks, everyone. And just a reminder, we have another 4 companies presenting tomorrow morning, kicking off a little bit later. We're kicking off at 11 rather than 10:30, and I will see you then. Thank you very much.